When the market crashes, confidence shatters, and the fiscal lifeline frays. Once a stock market collapses, confidence shatters. When confidence is gone, fiscal stability fractures. In response, the Federal Reserve prints money. Markets rise. Government tax revenue sees a temporary bump, which ironically leads to more debt issuance. So, the government prints even more money. This creates a cycle of using debt to prop up the market. The logic appears to create prosperity, but in reality, it's mortgaging the future. So, the question everyone is really asking is, can you still invest in US stocks right now? Is it time to sell? The current issue isn't whether US AI companies are viable, but rather, how long can their liquidity lifeline last? The truth is, the truly smart money has already started playing defense. Look at Warren Buffett. He has been quietly doing the opposite of buying. He's now sitting on a record $380 billion in cash, the largest cash pile in his investing career. Over the past year, Buffett has been a net seller of US stocks. He sold a significant portion of his Apple stake, cleared out some bank stocks, and consistently added to his cash and US Treasury bill holdings. He's been a net seller for several consecutive quarters. For Buffett, this kind of action points to only one conclusion: he thinks the entire market is too expensive. Many ask if Buffett is turning bearish. Not exactly. He simply finds nothing cheap enough to buy in the current market. Think about it, AI, chips, tech stocks are all at lofty heights. PE ratios are soaring towards the top of their historical ranges. Even Apple, his longtime favorite, has become too expensive in his view, no longer worth adding to, but rather, worth trimming. As for cash? He'd rather park it in US Treasury bills than buy stocks he considers overpriced. He's waiting for a real, major opportunity. For him, cash isn't a sign of being conservative, it's a weapon. This aligns perfectly with the illusion of prosperity we discussed. When a market's rise is propped up by liquidity and fiscal illusions, the smart money won't chase it. They quietly step back. Buffett's choice is essentially telling us, he sees valuation risk in the market, but he doesn't yet see a crisis-level price. In other words, he believes the current US stock market offers an asymmetrical risk-reward profile, the potential downside outweighs the potential upside. So, what should the average investor do? The answer is quite simple, it's not about a full retreat, but about active defense. If you're heavily invested and sitting on significant profits, and you're worried about potential liquidity tightening in the coming year, consider modestly reducing your position to lock in gains. If you are a long-term investor, meaning your money won't be needed for 10 or 20 years, then be patient. Don't chase rallies, don't go all in. Continue dollar cost averaging, maintain a diversified portfolio, and hold cash. Because holding cash itself is the ability to buy future opportunities. Look at it this way, while everyone else is frantic to get in, Buffett is waiting. When genuine panic grips the market, that is when he will step in and buy the bottom.